is a great starting point for guiding next week's efforts. Do more of what works. It's the essence of the solution focus. Another technique for sustaining the solution focus, referenced at the end of the last lesson, is to identify a mentor or trader you respect and ask yourself how he would be trading a particular idea. Sometimes it is very helpful to try out solution patterns that you borrow from others. Over time, you adapt these patterns to your own ways of thinking and trading so that they become distinctly yours. For example, I've worked with quite a few hedge fund portfolio managers and have learned from them the importance of thinking thematically about markets, observing various sectors and asset classes, and creating narratives that guide a longer-term perspective. The specific themes I track and the time frames I monitor are completely different from theirs, but there is a similarity of process. When I'm not trading well, I can model their processes and place myself more in line with market's trends. Still, another way to keep the solution focus is to make special note of mistakes that you don't make in your trading. These notes represent exceptions to problem patterns. If there's a mistake you've made lately, it helps to hone in on occasions when you haven't made the mistake. What are you doing differently at those times to avoid the mistake? Perhaps you're anticipating the problem and consciously doing something different. Maybe you're avoiding the mistake by following a particular rule or practice. Whatever helps you do less of the wrong things can also form the basis for solutions. Look to situations in which you don't make your worst mistakes. Many times, those situations hold the key to avoiding problem patterns more consistently. The real power of the solution focus is that when you discover what you do during your best trading, those positive patterns are uniquely yours. Instead of ceding the role of expert and guru to others, you're turning yourself into your own guru by finding the best practices that are unique to you. You become your own role model. This is one of the most promising facets of self-coaching. By discovering who you are at your best, you can create goals that are specific, unique, and relevant to you. The learning, as a result, will be more relevant and empowering, reinforcing strengths as you build them. A great assignment is to review your trading journal and assess the ratio of problem entries, writings about your bad trading, to solution entries, writings about what you're doing best. If the ratio is lopsided in favor of the problem focus, consider structuring your writing to force yourself to address a few basic questions. What specifically am I doing best in my recent trading? How specifically am I avoiding old trading mistakes when I'm trading well? How specifically am I trading like my idea of the ideal trader during my best trading? A good sports coach never loses sight of a player's potential, even when correcting weaknesses. The challenge of self-coaching is never losing sight of your strengths, and then working daily on how you can maximize them. Coaching cue. We have solution markets as well as solution patterns of behavior, specific markets and market conditions that facilitate our most successful trading. Knowing these intimately is very helpful in allocating risk to your trade ideas. It can also be helpful in staying out of certain kinds of trades and emphasizing others. Lesson 36. Disrupt old problem patterns. As you continue your journaling over a period of weeks or longer, you will become attuned to your problem patterns. Usually, a trader does not have 10 different problems. Rather, he may have 1 or 2 problems that manifest themselves in 10 different ways. For instance, a trader may grapple with missing good trades, occasionally ignoring stop-loss levels, sizing positions too conservatively, and cutting winning trades too quickly. These examples may seem like different problems, each requiring a different coaching plan and process. As the trader examines his or her journals, however, they're likely to find that a single problem pattern, anxiety related to negative self-talk, is responsible for all of these. It's not that the trader has many problems, though it may certainly feel that way. It's that there is a single core problem that affects many aspects of the trading process. As you can see from the above example, self-coaching requires that you not only detect patterns, but patterns among the patterns. It's these patterns of patterns that usually form the core focus of coaching efforts. This means that if you can accurately identify the core pattern, many different trading difficulties can fall into place in a reasonable period of time. Once the trader in our example learns to master anxiety and not channel it through self-defeating self-talk, he will miss far fewer opportunities, become more consistent in sticking to stop-loss levels, take appropriate risk, and let trades progress toward their designated targets. Asking yourself, what is the common denominator behind my different trading mistakes, begins the process of finding patterns of patterns. Often the core pattern will involve a feeling state that recurs for the trader and that disrupts good decision-making. For example, the trader may lapse into periods of anxiety, frustration, or self-defeat. How this feeling state impacts trading may vary from day to day, which is what produces the multiple manifestations that lead traders to think that they have dozens of problems. By tracing each trading problem back to a particular cognitive, thinking, or emotional, feeling state, we can then identify the events that typically trigger that state and design effective coaching interventions to tackle those situations and triggers. Often, a trader will know what he is doing wrong, but won't know the right thing to do. This issue occurs when traders have not been sufficiently solution-focused. They know, for instance, that they should not double down on losing trades to make money back, but they don't know how to re-enter a trade and exploit good research after having been stopped out of an initial position. This situation requires two important coaching steps. 1. Interrupt the problem pattern so that it does not disrupt trading. And 2. Develop rules and procedures for a possible solution pattern, which will form the theme of the next lesson. Because traders don't always have solutions readily at hand and need to stop bleeding losses, interrupting problem patterns is often a first coaching objective. Above all else, do no harm. The Socratic oath in medicine is relevant here. The ability to stop doing wrong things won't, by itself, generate good things, but it can keep you solvent long enough to find solutions. Change starts when you stop yourself from doing what doesn't work. A major point from the psychology of trading is that the key to disrupting problem patterns is to alter the state that you're in when those problems first appear. This means that it's important to become vigilant to the emergence of patterns, recognizing the characteristic ways that they appear. For example, some of my worst trading occurs when I focus on my P&L as the trade is unfolding. This focus may lead me to tolerate larger than normal losses in a small position because it's not hurting me, or it may lead me to take profits too quickly on a large position to book a sure gain. I've learned that if I start counting profits during the trade, I need to refocus my attention. I accomplish this by turning briefly from the screen, fixing my gaze on something nearby, and taking a few deep breaths. Once I'm in a new state, more calm and focused, I find it easier to be detached from the P&L and let the trade unfold in its planned manner. Another quick way of shifting state is simply to walk away from the screen temporarily and engage in a quick activity unrelated to trading. Some activities might be a few stretches or exercises, talking with a fellow trader, or getting something to eat or drink. Often, doing something different enables you to approach situations differently. The new activity helps you shift your frame of thinking and feeling. I find this activity particularly useful after taking losses. A quick walk outdoors, getting away from markets, allows me to return to the screen with a fresh perspective. When you change your physical state, you alter how you experience the world and process information. Still another mode of state shifting is to write in a journal or talk aloud during a particular situation. The latter is especially useful if you're trading alone and won't be a distraction to others if you process information aloud. If you write or talk about what is happening and give voice to what you think and feel at the time you're thinking and feeling it, you shift from being a person immersed in experience to being a person observing his own experience. If you're an active trader, in and out of markets quickly, you may not have time to write out journal entries and observe yourself in that manner. Talking aloud, however, can be accomplished while still watching the screen. In fact, that's how many traders in Chicago work with me during the trading day. They talk aloud about what is happening while they are engaged in trading. To use my example from above, if I talk aloud my thoughts about my P&L while I'm in a trade, that alerts me to the fact that I'm no longer focused on the trade itself. If I hear myself talk about something other than the management of the present trade, it kicks me into a different mode and pushes me to make an effort to get back to the market itself. This shift becomes easier and easier as traders learn to make self-observation a habit. When you talk aloud your thoughts and feelings, you no longer identify with them. You listen to them as an observer. A good self-coaching question to ask yourself is, how different would your P&L be if you could eliminate the 5% of your largest losing trades? Often this percent by itself would make a huge difference to a trader's profitability. By interrupting the patterns that accompany those large losers that result from bad trading, not just being wrong on an idea, you can, above all else, do no harm. It's usually a particular emotional state or pathway of thinking that triggers the bad trading. If you recognize the state and thoughts as they're occurring, you can stop yourself and, at the very least, avoid disaster. This recognition would make a wonderful goal to work on in your trading. Choose just one negative pattern that has accounted for many of your largest losing trades, and then identify the common triggers for that pattern. Then select one method for interrupting the pattern when you notice one of the triggers occurring, even if that method is doing nothing more than placing no more trades until you regain emotional equilibrium. A good coach knows when to take his player out of the game for rest and a lesson. When you are your own trading coach, sometimes you need to do something similar. Remember, the goal is not to trade. The goal is to make money. Sometimes the best way to make money over the long haul is to ensure that you keep your money when all the wrong patterns are firing. Coaching cue. If I say something in a frustrated tone or make a frustrated gesture while I'm trying to get into a trade, while I'm managing a trade that's already on, or while I'm trying to exit, that is my signal that I need to interrupt an emerging pattern. I typically will slow my breathing considerably and focus on my breathing as I'm continuing with my business. As soon as is practical thereafter, I take a short break from the screen and don't enter any new positions until I have figured out why I'm frustrated, what that tells me about me and/or the market, and how I want to factor that into my trading. If you use frustration as a cue to interrupt patterns, you are prevented from acting mindlessly on the frustration, but also you are set up to become mindful of the reasons for the frustration. Lesson 37. Build your consistency by becoming rule-governed. One of the major goals of coaching yourself is to turn positive trading behaviors into habit patterns. This is crucially important. You don't want to have to think and make yourself do the right things each time opportunity occurs. Rather, you want to do the right things automatically. Effort and energy you spend thinking about what to do and trying to make yourself do it is taken away from markets themselves. When you can do the right things automatically, your concentration can be wholly focused on what you are doing. That is essential if you're going to be sensitive to subtle market shifts in supply and demand. Rules are the bridge between new behavior patterns and acquired habits. Children are not born with a developed sense of ethics and responsibility. They are taught rules by parents and teachers that are eventually internalized. Some of that internalization occurs by observing role models over time. Much of it results from turning the desired behaviors into explicit rules that can be rehearsed. Such mental rehearsal allows people to keep old behavior patterns in check and make conscious efforts to engage in new ones. We see such dynamics at work when traders are learning to control losses. Instead of exiting trades when the pain of loss is too great, a pattern that comes all too naturally, a trader will create a rule-based stop-loss level. The rule may be accompanied by other thoughts that emphasize the importance of the rule, the losses that will follow from not following the rule, and the benefits of adhering to the rule. In such an instance, traders choose to refuse to do what they feel like doing at the moment. Rather, they seek to be rule-governed. That is what keeps us driving on the proper side of the road even when we're in a rush. Rules are checks on our impulses. They keep us doing the right things even when we're not inclined to act in our own best interests or the interests of others. We follow social rules without even thinking about the rules of proper social behavior because we've repeated the right behaviors so often and have internalized the rules so thoroughly over time. That's the goal with trading rules. Trading is especially challenging because the normal human response is rarely the one that makes money. One exercise from the Trader Feed blog examined periods of time that were up on a 1 month, 1 week, and 1 day basis, and compared those with periods that were down over those 3 time frames. In the first situation, almost anyone would identify the trend as rising. In the second situation, it's a clear downtrend. Had you bought the market after the up periods, however, you would have severely underperformed the market averages. Had you sold after the down periods, you would have lost considerable money. The obvious strategy fails precisely because it is so obvious. By the time a trend is readily apparent, all the momentum and trend followers are aboard. They're the ones scrambling to get out when the tide turns, leaving traders who acted on the obvious with losses. When we create rules, we put a brake on those normal human tendencies. A rule might be as simple as, only buy if the market is down over X period. Surprisingly, in the broad stock market, such a simple rule works pretty well on average. Another rule might be, never enter a trade unless you first measure risk, stop-loss level, and reward, profit target, and have a reward-to-risk ratio of 2-to-1 or better. Such a rule would restrain a trader who is tempted to jump aboard late in a market move. What traders call setup criteria often are simply rules for getting them into trades. When the criteria are not established as firm rules, and mentally rehearsed as such, there is a tendency to violate the setups. This violation often occurs because of the fear of missing a profit opportunity or because of risk aversion after a prior loss or series of losses. When the setups are structured as rules, trading may not be mechanical, but it can be much more consistent. Most frequently, the inconsistent trader is the one with the loosest rules. Rules aid trading consistency. When you are your own trading coach, you not only formulate your rules, but also must do so in a way as to maximize the odds that you will actually follow them. The key to successful rule creation is the recognition that rules are more than thoughts that go into your head. A good rule also comes with feelings attached, an awareness of both the consequences of violating the rule and the benefits of following it. What keeps a diabetic person faithful to a diet, or an eager child patiently waiting her turn to answer a question in class? It's not just the thought of the rule, but also the immediate sense of what would happen if the rule were violated. When people think, I can get away with it, the rule loses its force. It's merely a set of empty words and good intentions. This, then, is the secret to formulating trading rules, whether they relate to entries, exit, position sizing, stop losses, diversification, or idea generation. Whenever you write down the rule or mentally rehearse it, make sure that you are emotionally connected to that rule. Make yourself relive situations in which you violated the rule. Focus your attention on successful episodes of trading in which you followed the rule. Make the rule more than a guideline. It should represent a belief and conviction. The best rules feel like must, not just should. Your assignment is to take a thorough trading inventory of your trading rules. How many do you really have, and how explicit are they? Do you just remind yourself of them passively, or do you rehearse them with belief and conviction? If you're like most traders, you'll find that you have many loose guidelines but few firm rules. That means that you haven't really drilled down to identify the patterns behind your best and worst trading, which really form the backbone of all good rules. Rules should reflect best practices in trading. Remember, you can't follow a discipline that you never formulated in the first place. The clearer the rules, and the more you feel them, the stronger they will serve as brakes to your impulses and guides to your best behavior. Rules are not straitjackets. They free you up to be your best. Think of professions in which consistency is a virtue. Airline pilots landing an aircraft, surgeons making incisions, race car drivers maneuvering in a pack. The best performers are rule-governed. They are keenly aware of the dangers of ignoring the rules of their profession. It is in the internalization of their rules that they achieve flawless execution. That is your goal in coaching yourself, to make rules so routine that they make extraordinary performance the norm. Coaching cue. Rule following is a great basis for self-evaluation. Creating checklist report cards to track your rule governance helps ground you day to day in best practices. Among the rules you should consider formulating and tracking for self-assessment are rules for position sizing, rules for limiting losses per trade, per day, per week, etc. Rules for adding to existing positions, rules for when you stop trading or limit your size or risk, rules for increasing your size or risk per trade, per day, etc. Rules for entering and exiting positions. Rules for preparing for the trading day or week. Rules for diversification among positions. Not all these rules will apply to all traders. The key is to focus on the rules that capture your best trading and turn those into report cards for daily or weekly self-assessment and goal setting. Lesson 38. Relapse and Repetition. The greatest enemy of coaching is relapse. It is relatively easy to initiate change, but quite difficult to sustain it. Our old patterns are what come naturally. They're what we've been doing day after day, year after year. Those patterns are overlearned. They have been repeated so often that they have become automatic. If change efforts are not sustained, the automatic patterns naturally fill the void. What this means in practice is that there is a certain series of stages to any change process. Phase 1. We repeat old patterns automatically, experience consequences, and try to avoid the consequences as much as possible. Phase 2. Consequences of old patterns accumulate, and we develop an awareness of the need to change, though we may not know how to change and may have ambivalent feelings about change. Phase 3. We can no longer accept the negative consequences of our old ways and commit ourselves to making changes by trying to think and act differently. Phase 4. We slide back into old patterns periodically when our change efforts lose momentum, creating oscillating periods of change and relapse. Phase 5. We engage in new patterns sufficiently often that they become automatic, greatly reducing the relapse into old ways. So let's take a practical example. In Phase 1, we are in an unfulfilling romantic relationship, but minimize the problems and try to go on from day to day. In Phase 2, we recognize that the problems are there, but wrestle with the question of whether we really want to rock the boat and raise concerns with our partner. Phase 3 brings clear awareness of the need for change and discussions at home to work out problems. Phase 4 sees periods of good times, interrupted by resumptions of the problematic interactions, perhaps aided by couples counseling. In Phase 5, we keep working on the counseling exercises, changing patterns of communication, until there are new and more constructive ways of engaging each other that have become routine. This stepwise scheme suggests that relapse is not merely a problem, it is a step on the road to change. Few people change patterns all at once and for all time. More often, there is a tug of war between the old, overlearned patterns and the new, constructive ones we're working on. This tug of war occurs precisely because the new patterns have not yet been overlearned. It takes conscious effort to enact them. Early in the change process, we don't think about change. In the middle phases, we have to think about change in a very conscious manner. Only late in the process do the new behaviors come more naturally and automatically. In every change process, there is an intermediate phase in which old problem patterns coexist with new positive ones. Relapse at this stage is the norm, not necessarily a sign of failure. So what enables us to make the transition from effortful change to an internalization of new patterns so thorough that those patterns become second nature? If you think back to when you learned to drive a car, there was a period when you had to consciously focus on every aspect of driving, from signaling and making turns to changing lanes. Only with repeated experience did these activities become automatic, freeing you up to focus on road conditions when necessary, converse with passengers, and locate unfamiliar destinations. Similarly, repeated experience with new cognitive, emotional, and behavioral patterns in trading is what cements these patterns and frees you up to focus on markets. Relapse is overcome through repetition. Only when new behaviors have been repeated many times, in many contexts, do they begin to become automatic, overcoming the tendency to relapse. We saw in the lesson dealing with goal setting that, as your own trading coach, you don't want to set a goal one day, another goal the next day, and still a different one later that week. This is a common flaw with many trading journals. Traders take steps to initiate change, phases 3 and 4 above, but fail to cement the changes through repeated experience. It is far better to focus on one or two changes and institute those with regularity over a period of weeks and months than to try to make many changes in a short period of time. Your assignment, following the discussion of rules from the previous chapter, is to review your current trading goals and assess how well you sustain work on them day after day. Ideally, your goals and the changes you attempt to make should be expressed in such a manner that you will necessarily have to work on them each and every trading day. One way to foster this consistency is to generate a daily report card in which you grade yourself on your enactment of the behaviors you try to cultivate. The goal is to achieve good grades each day, not just hit your targets on a particular occasion. Similarly, if you are writing about your goal performance each day, the mere act of thinking about your new behaviors and evaluating them will serve as a kind of repetition. You're much more likely to stick with new behaviors if they command top-of-the-mind awareness. Talk about the changes you're making, write about them, grade yourself daily on them, and, most of all, enact them during each day's trade. As with the driving, before too long you'll find yourself doing the right things automatically. At that point, you don't need motivation. You've turned goals into habits. Coaching cue. Engage in an important goal-oriented pattern as your first activity of the day to build momentum for a purposeful day. I've worked with traders who stuck with their trading goals much better after they began programs of physical fitness. Their fitness work forced them to be goal-oriented to start their day, which carried over into their trading. You're not just training yourself to trade better, you're training yourself to sustain change efforts across all facets of life. Lesson 39. Create a safe environment for change. In the last lesson, we took a look at the importance of repetition in cementing new patterns of thinking, feeling, and behaving. The single most common reason why skilled traders fail to coach themselves to higher levels of performance is that they initiate changes but fail to sustain them. As soon as they make improvements, they relax their efforts and fall back into old ways. A successful coach knows when the opponent is on the ropes and doesn't let up. When you have a positive experience, you want it to be a motivation for further positive experiences, not a cue for complacence. The best coaching efforts develop a kind of momentum in that way, adding success to success and sustaining a sense of mastery and accomplishment. The problem with experience is that it takes time. Particularly if you're a longer time frame trader, many weeks or months of trading may pass before you have the opportunity to build a large base of new experience. If only you could multiply your experience, you could accelerate your learning curve. Changes that would otherwise take months could be accomplished in a few weeks. The way that coaches in sports and the performing arts multiply experience is through repeated practice. A team might only play opponents on the weekend, but will practice every day to prepare for the games. Similarly, actors and actresses will rehearse their lines every day before opening the curtains for the actual production. During those practice sessions, performers condense the coaching process. They learn what they're doing right and wrong, make conscious efforts to repeat their positive performances and correct their faulty ones, and eventually reach the point where their efforts become natural and automatic. Practice is valuable because it creates a safe environment for making mistakes. The game won't be on the line or the play won't be ruined if a performer tries something new and it falls flat in practice. Rehearsal speeds the learning curve. Practice can be very helpful to your efforts to coach yourself. If you identify a specific change to make, the place to begin is in simulated trading where no capital is at risk. This can occur in several different ways. Simple chart review. Sometimes the changes you make to your trading involve decisions regarding how you would enter, exit, or manage risk. When those are your goals, you can review charts and simply talk aloud the decisions you'd be making at each juncture. This lacks the realism of real-time trading and cannot substitute for real-life experience, but it does slow the decision-making process down to the point where you can try new things in a very conscious, reflective manner. My favorite way of engaging in the chart review is to advance the chart on my screen one bar at a time and then talk aloud my perceptions and decisions. This is like first learning to drive a car by driving very slowly in a large, empty parking lot. It gives the learner plenty of time to crawl before walking and running. Simulated trading. My charting software comes with a simulation feature in which I can place orders and track my profits and losses over time. This is helpful because you're making decisions with real market data in real time, but placing no capital at risk. By trading in simulation mode, you can gain many days' worth of experience in a single day. You can also focus your attention on the most problematic and challenging market occasions, concentrating your skill rehearsal in contexts that most call for your new patterns. Trading with reduced size. Not all of the changes I seek in my own trading are revolutionary. Some are evolutionary tweaks. Recently, I altered the criteria by which I set profit targets, allowing me to hold certain trades for a bit longer. I reduced my trading size in half when I traded with the new criteria, knowing that the extended holding times would, by themselves, be uncomfortable for me. Once I developed a comfort level with the lowered size, and made my mistakes with the smaller risk exposure, I then gradually returned to my prior level of risk. Learning is best started in very safe environments, and only later tackled in riskier situations. If you violate safety and security, you create distractions that interfere with learning. Note that if I were to make radical changes in my trading, say switch from trading equity indexes to trading agricultural commodities, I would need an extensive period of time with chart review and simulation prior to putting any capital at risk. These more substantial changes take longer to internalize. There is a more extensive learning curve. On average, we'll make more mistakes when we attempt large changes rather than small tweaks. When you are your own coach, you provide more security and safety for big change efforts. The smaller pattern shifts can proceed with live trading and reduced risk exposure. One of the greatest mistakes traders make is to make a change once or twice and then jump immediately into larger risk-taking, giddy with the prospects of new returns from new habits. It is not unusual in my coaching and trading experience for trading results to get worse before they get better when tackling meaningful changes in trading practice. Just as you wouldn't learn how to use the car's brakes and gear shift in a couple lessons and then jump into highway driving, you don't want to greatly alter your decision-making process while running full risk. As the Enhancing Trader Performance book stresses, the worst psychological mistake you can make is to traumatize yourself. If you create large drawdowns in your account because you weren't prepared for your changes, the result will be damaging to both your trading performance and to your self-coaching. You want to structure the change process as much as possible to provide frequent successes and no emotionally damaging losses. This is how you sustain confidence and self-efficacy, even as you make your mistakes. Many traders are too eager to trade. They crave excitement and profits and find it difficult to trade in observation, simulation, and reduced risk modes. This short-circuits the process of generating repetitions that cement new patterns. Once traders undergo losses while making changes, they become self-doubting and pull back from their change efforts. Instead of generating success and confidence, traders learn to fear change. An important key to coaching yourself is to turn yourself into a generator of concentrated experience by making maximum use of practice and feedback. We often seek change after periods of loss. It's human nature to want to jump back into markets and regain the lost capital. But the goal is to instill the right trading behaviors, not to make money back all at once. If you internalize the right patterns, the results will naturally follow. Your assignment is to embed concentrated learning into your schedule by allocating time for daily rehearsal of new skills and patterns. An excellent goal is to generate 2 days' worth of learning experience into every day by rehearsing new patterns outside of trading hours as well as during them. Replay market days either in video mode or through a simulation platform that has a replay feature to accomplish this goal. I know from the traffic statistics on my blog and others that traders spend less time gathering market information after the close of trading, and especially during weekends and holidays. Traders use the hours outside of trading to get away from markets. No one argues with the need for and desirability of life balance. But a 9-to-5 approach will work no better in trading than it would in running a business or building a career as an artist, scientist, or athlete. When you read about elite performers in any field, one fact stands out. They are not the clock punchers. They are absorbed in their interests and, as a result, learn far more than others. They develop new skills and competencies far more readily than their peers simply because they multiply experience. Many traders back away from the screen when they have trading problems, thereby reducing their experience. During the worst drawdowns, you want to minimize your trading and risk exposure, but maximize your work on markets. When you create safe environments for changing yourself and your trading, you mimic the learning behaviors of the greats, from concert pianists to chess champions to Olympic athletes. When you start with practice that encourages errors and learning from them, development becomes a joy, not a burden. This is self-coaching at its finest. Coaching cue. The video recording of markets for later review is an excellent way to multiply experience. Replaying the market day allows you to watch patterns unfold again and again under different market conditions. Reviewing market moves that you missed sensitizes you to future occasions of opportunity. Lesson 40. Use imagery to advance the change process. The previous two lessons have emphasized the importance of repetition in cementing new ways of behaving and unlearning old patterns. By creating new opportunities to rehearse fresh skills, insights, and behavior patterns, we accelerate their internalization, freeing our minds for the basic tasks of trading. A huge advantage of the human brain in this context is the ability to generate experience virtually through the use of imagination. If we vividly imagine a specific trading situation and visualize ourselves step by step enacting a new way of handling that situation, the mental rehearsal approaches the power of actual experience. You do not have to trade to rehearse many trading-related behaviors. By creating realistic situations in our minds and using imagination to summon our desired patterns, we can also cement these patterns. A technique that makes use of this kind of visualization is the stress inoculation approach, first described by Donald Meichenbaum. By mentally summoning stressful market scenarios and imagining in detail how we want to respond to these, we inoculate ourselves against those stresses by priming our coping mechanisms. This mental preparation can be applied to a range of situations, from ones that are psychologically challenging to those that require new trading methods. Our coping is mobilized when we imagine anticipated stressful situations, preparing us for when those situations actually occur in trading. The key to making effective use of imagery is ensuring that the imagery is vivid and evokes real feeling. Unlike a simple verbal repetition of a trading goal, imagery has the power to evoke the emotions associated with situations. This imagery turns the verbal recitation into a much closer approximation of trading experience. When we vividly imagine a trade going through our mental stop-loss level before we can execute an exit, we summon some of the fearful or frustrated feelings normally associated with unexpected loss. While we experience a mild version of the trading emotions, imagery can rarely fully duplicate actual experience, we can rehearse our best practices, keeping ourselves planful and disciplined in the face of stress. This mild exposure to the trading stress is like the body's exposure to a weak form of a virus. It inoculates because it is strong enough to arouse adaptive responses, but not so strong as to pose a major threat. Few psychological techniques are as recognized and recommended as imagery, and few are executed as poorly. There are several facets of effective imagery exercises. Specificity. It's not good enough to imagine a stressful situation, such as losing money or missing an opportunity, in the abstract. The imagery should be very specific and guided, visualizing a specific market and market situation, specific price levels, and specific market action. It is the realism of the imagery that enables the exercises to serve as substitutes for actual experience. Dynamism. The imagery should be more like a detailed, realistic movie rather than a broad, static snapshot. If you read a newspaper description of a situation, your reaction isn't as strong as it would be if you were to see the same situation dramatized in a movie. The dynamic nature of imagery is essential to its realism, which in turn is essential to the inoculation process. Flat, unconvincing images won't arouse our coping, and they surely won't be effective approximations of real trading experience. Elaboration. If I had to identify the most common shortcoming in people's use of imagery as a change technique, it would be their tendency to cut the imagery work short. Longer, more elaborated exposures to imagined challenges are more effective than very brief exposures. Indeed, if the exposures are too brief, you may unwittingly reinforce the pattern of fleeing from stresses. The best practice is to imagine a situation from beginning to end in elaborate detail, and then repeat the scenario until it no longer evokes emotion. This practice not only reinforces coping, but mastery and success. An interesting technique from the behavioral literature is flooding. prolonged exposure to imagined situations that are highly stressful. Traders learn to stay in control even during a flood of stressful imagery, so they prepare themselves for most anything the markets throw at them. Variation. Traders commonly imagine a challenge scenario, evoke the imagery, and then quickly move on to something else. As we've already seen, repetition cements learning. By failing to use the principle of repetition in the area of imagery, traders open themselves to the risks of relapse. Once you evoke a detailed, realistic trading scenario and how you would handle it, and once you repeat the scene to the point of mastery, you then want to create variations on the scenario. For instance, you might begin by imagining a frustration associated with a fast-moving market. If your goal were to learn new coping patterns during periods of frustration, you would master this first scenario and then create variations, such as frustrations associated with slow markets or not getting filled on orders. Vary the scenarios and you can generalize your learning and make it increasingly applicable to actual trading conditions. Consistency. Any single imagery session will not affect behavior over days and weeks. It is the daily repetition of the sessions that yield enduring results. Many traders derive some benefit from initial imagery work and then promptly return to business as usual. Consistency in the use of exercises ensures that the new patterns you're rehearsing will remain top of the mind over time. Frequent use of imagery work is a great way to sustain mindfulness about change and the need for change. When you are your own trading coach, you want to see and feel yourself to be successful, not just engage in occasional thoughts of success. In your internal world, you can practice skills, engage in new thought patterns, and achieve goals with consistency long before you actually accomplish all of those in live trading. Your assignment is to generate powerful, elaborate imagery scenarios of stressful, challenging market situations. The thoughts, feelings, and behavior patterns associated with those, and the specific steps you want to take to master those situations. When you construct your guided imagery, you want to feel the emotions of fear, greed, frustration, and boredom, and imagine yourself tempted to engage in your usual negative patterns in response to those states. In your imagined scenario, you will vividly envision yourself keeping those negative patterns in check and purposefully enacting your best practices. Thus, for instance, you might imagine yourself tempted to add to a position when it goes through your stop-loss level, but checking that temptation and instead acting on the stop. Imagination for the trader is the equivalent of a practice field for an athlete, a place to prepare for performance by creating simulated performance situations. You will be the trader you are capable of being in your imagery work and practice long before you consistently enact those ideals in your daily trading. There is no reason to take months or years to change behavior patterns when you can make every day an experience of concentrated learning. Much of successful self-coaching is the result of a creative and tenacious use of imagery and practice. Coaching cue. Use your imagery to imagine yourself as the kind of trader you aspire to be, the risk-taker, the disciplined decision-maker, the patient executioner of ideas, the canny trader who learns from losing trades. If you create a role and an image of yourself in that role, you enact scenarios that, over time, become part of you. Resources. The Become Your Own Trading Coach blog is the primary supplemental resource for this book. You can find links and additional posts on the topic of coaching processes at the homepage on the blog for Chapter 4, becomeyourowntradingcoach.blogspot.com/08/daily-trading-coach-chapter-4-links.html. Much of the framework discussed in this chapter comes from research into helping processes in brief therapy. Standard reference works in this area include the chapter on brief therapy written by Dewan, Steenbarger, and Greenberg for the volume Textbook of Psychiatry, 5th edition, Volume 1, edited by Robert E. Hales, Stuart C. Udofsky, and Glenn O. Gabbard, American Psychiatric Publishing, 2008, and the chapter on brief psychotherapies by the same authors for the reference work Psychiatry, 3rd edition, edited by Alan Tasman, Gerald K., Jeffrey A. Lieberman, Michael B. First, and Mario Maj, Wiley, 2008. An excellent framework for thinking about making the most of strengths is the Gallup research described in Now Discover Your Strengths, written by Marcus Buckingham and Donald O. Clifton, The Free Press, 2001. See also the popular management text Good to Great, written by Jim Collins, Harper Business, 2001. A full description of solution-focused work can be found in my chapter Solution-Focused Brief Therapy, Doing What Works, in The Art and Science of Brief Psychotherapies, edited by Mantosh J. Dewan, Brett N. Steenbarger, and Roger P. Greenberg, American Psychiatric Publishing, 2004. Chapter 5. Breaking Old Patterns. Psychodynamic Frameworks for Self-Coaching. The strangest and most fantastic fact about negative emotions is that people actually worship them. P.D. Ouspensky. To this point, we've been exploring processes that are common to all change efforts and all performance coaching. Now we begin a look at individual frameworks for coaching, beginning with psychodynamic modalities. These frameworks are approaches that emphasize the continuity of past and present, how old patterns replay themselves in the present, and the ways in which current relationships can remake patterns born of prior, negative relationship experiences. The psychodynamic framework is more commonly connected to long-term psychoanalysis than to coaching, but I've found tremendous value in utilizing the medium of relationship experiences to help traders with their performance. This chapter will explain how psychodynamics are related to trading and how the dynamic framework can inform your own efforts at self-coaching. I personally draw most upon dynamic modalities when I'm working on trading problems that are part of larger life challenges, particularly when those challenges have been part of our life histories prior to trading. Many issues that impact trading, concerns over success or failure, self-confidence or self-doubt, security or insecurity, predate our trading efforts, but play themselves out in how we make financial decisions. The best way to describe psychodynamics is as a way of thinking, as well as a set of tools to help ensure that people's pasts don't become their futures. And, in the context of this book, it all starts with a single insight. We have relationships with our markets, and those relationships repeat patterns that we've enacted in other relationships. Let's take a look at how we break free of those patterns. Lesson 41. Psychodynamics. Escape the gravity of past relationships. The psychodynamic approaches to change have evolved significantly from the psychoanalytic work of Sigmund Freud and the subsequent contributions of neo-Freudians. In the process of this evolution, psychodynamic thought has turned away from viewing instincts and sexuality as the primary basis for behavior and toward an interpersonal understanding of recurring conflicts and patterns. At the same time, psychodynamic psychology has also departed from the analytic couch and the presumption of therapy as a long-term process, emphasizing more active, shorter-term methods of change. Surprisingly, this evolution has largely taken place outside the public eye, contributing to a perception that analytic methods are outmoded and outdated. Nothing could be further from the truth. The core perspective of the psychodynamic model is that current problems are reenactments of conflicts and patterns from past relationships. The self is viewed as the result of years of internalization of relationship experiences. When we enjoy positive, affirming relationships, we internalize a positive self-image and concept. Negative, conflicted relationships are internalized as a negative and conflicted sense of self. This perspective touches on one of the themes from earlier in this book. Relationships serve as mirrors by which we experience ourselves. We are the sum of our significant relationship experiences. Over the lifespan, we learn coping strategies, defenses, for dealing with the anxieties brought by relationship conflicts and their consequences. These defenses may be successful in warding off discomfort, but they tend to become outmoded in future relationships and life situations. When current situations trigger the feelings evoked by past relationship problems, our outmoded defenses lead us to behave in ways that bring unwanted outcomes. These patterns of feelings evoked from the past, along with the defensive reactions and negative consequences, constitute what Lester Luborsky calls core conflictual relationship themes. These themes repeat themselves in various ways across various situations, causing us to behave in unwanted ways. The purpose of counseling and therapy, from this vantage point, is to free us from these cyclical, maladaptive patterns. When we overreact to situations, the odds are good that we're reacting to themes from our past as well as the current situations that trigger those themes. To use an example from the psychology of trading, I grew up in a very close family. My parents were both estranged from their parents and vowed to create a very different family environment for their children. They were so successful in that regard that I sometimes felt that the environment was too close. I sought privacy, taking long bicycle rides, walks, and even showers. Later, when I met my wife Margie and became part of a household with her 3 children, I found myself taking long showers and withdrawing from family life. This disrupted morning routines and led to a bit of tension in the household. For years, I had lived alone and had never experienced the feeling of being too close to others. When I entered a new family situation, the old feelings from my formative experiences came back to me, and I coped rigidly in my old way by withdrawing and seeking privacy. What worked in childhood, however, failed dismally in the new family. By reenacting old defenses in new situations, I created a fresh set of problems. All of these defenses tend to happen automatically, outside of conscious awareness. Without some way of making these repetitive patterns conscious, we cannot change them. One goal of psychodynamic work is to make the unconscious conscious, to make us self-aware, so that we can find new endings to old conflicts. I was able to change my patterns within the family once I recognized that I no longer needed to cope in ways from my past. My present family wasn't my former one, and I was no longer a child. The first goal of psychodynamic work is insight, recognition and understanding of one's patterns, and awareness of their limitations. The key insight is simply, you had a reason for doing this in the past, you don't have to do it anymore. So how does this relate to trading? The risk and uncertainty of trading, the gains and losses, victories and defeats, have an uncanny way of triggering feelings from our past. A classic example is the trader who felt as though he never measured up to his parents' standards and expectations. He brings his sense of inferiority to the markets, taking imprudent risks to prove that he truly is a success. Of course, no amount of winning in markets can fill the emotional void, leading him to take ever greater risks until he finally blows up and confirms his worst fears. In such a situation, no tweaking of trading methods will solve the trader's problem. Until he resolves the conflict at the heart of his dilemma, he will continually find himself acting out his personal dramas in his trading. Many trading problems are the result of acting out personal dramas in markets. The best way to identify situations in which past conflicts intrude into current trading is to consult the feelings evoked by your trading problems. If they are similar to feelings you've experienced in past career and relationship situations, there's a good chance that they represent the leading edge of cyclical, maladaptive patterns. For instance, if your frustration gets you into trouble in your trading and has also gotten you into trouble with friends and romantic partners, there's a clear pattern that transcends markets. If trading leaves you with the same conflicted, hurt feelings that you've experienced in your past, that's a sign that the past is refusing to stay in the past. As your own trading coach, you sometimes need to dig beneath the surface of problems to discover their origins. This discovery must be accomplished by reviewing your personal history and mapping that history against recent experience. In other words, you want to look not only at your current patterns, but past ones as well. It's in the overlap that we can make greatest use of psychodynamic change methods. Your assignment is to take a sheet of paper and draw 2 sets of sine waves, each with at least 4 peaks and 4 troughs. For the first set of sine waves, you'll mark the peaks with the peak experiences from your life, your most positive and fulfilling experiences. These experiences can be taken from any life sphere, from relationships to career. You'll label the troughs with the most negative experiences of your life, again from any sphere. These experiences will be those filled with the most emotional pain and distress. By the time you're finished, the first sine wave chart should be filled with the highlights and lowlights of your life. When you're finished with the first set of sine waves, you'll fill out the second set similarly, only you'll limit your entries to trading-related incidents. Thus, you'll mark the peaks of the sine waves with your most positive and fulfilling trading experiences, and the valleys of the sine waves with your most painful and upsetting market-related experiences. Make sure that all of your entries from both sets of sine waves are described in sufficient detail that you can readily appreciate why each incident was a peak or valley experience. The real work comes in when you compare the peaks across the 2 sets of waves and the valleys. You're looking for common themes that link your life experience with your trading experience. Many of these commonalities will be at an emotional level. Here are some common ones to look out for. Themes of adequacy and inadequacy. Themes of rebellion against rules and discipline. Themes of boredom and risk-taking. Themes of achievement or hopefulness and failure or discouragement. Themes of recognition and rejection. Themes of contentment or acceptance, and anger or frustration. Themes of safety and danger. If the markets are making you feel the way you felt during some of your life's valley experiences, consider the possibility that you've been caught in a web of repetitive conflict and coping. Recognizing that web and keeping it firmly in mind is half the battle of changing it. As your own trading coach, you want to be mindful in your trading, not unconsciously repeating your past. It is much more difficult to fall into old, destructive patterns when you're clear on what those patterns are. Coaching cue. So often we're fighting the last psychological battle. Identify the most recent conflicted relationship experience in your life and the thoughts, feelings, and behaviors evoked by that relationship. Then take a look at your most recent trading difficulties to see if similar thoughts, feelings, and behaviors are involved. Many times, it's not just early childhood relationships that color our current behavior, but the most recent sets of conflicts. Identifying how you resolved those problems in the relationship, or are taking steps to resolve them if they are current, can be very helpful in minimizing their spillover into trading. Lesson 42. Crystallize our repetitive patterns. In the previous lesson, we used sine wave charts to identify peak and valley experiences from our life histories and from our trading. Once we have the sense that there are indeed commonalities, the next step is to crystallize these patterns so that we clearly understand why they exist and how they repeat themselves. First, however, let's address the question of what it means if you cannot find common themes across the peaks and valleys of your charted experience. One possibility is that you need to draw more peaks and valleys on each chart before the themes will become salient. Another is that you are looking at the events logically, not psychologically. Examine the peaks and valleys for similarities of motivation and emotion, not surface detail. Many times, the common elements will jump out when we think of the patterns as emotional recurrences. Sometimes, though, there truly aren't links between our trading problems and our prior life's challenges. The trading problems may simply reflect shifting markets, a lack of skills and experience, or situational factors related to present-day distractions. If these are the most important sources of current trading difficulties, the psychodynamic approach will be less relevant to your change efforts. Rather, you may need to structure your learning process as described in the Enhancing Trader Performance book, or you might need to adopt a framework that is more present-centered, such as the self-coaching approaches described in chapters 6 and 7. Not all trading problems have an emotional genesis. Sometimes we just need to hone our trading skills. In my experience, the most fertile area to seek for similarities between trading problems and prior life conflicts is in significant relationships, those with parents and romantic partners. Conflicts with parents and lovers are usually among the most emotionally powerful and are the ones we are most likely to defend against, and thus reenact, in our